How to use 12 U.S.C. Section 411 to eliminate your federal income tax legally? Most Americans have no idea there's a law in the U.S. Code that lets you legally stop paying federal income tax, without hiding income, without shady deductions, and without breaking the law. It's been there since 1913, and in the next few minutes, I'm going to show you exactly how it works. 1. Scope and boundaries of the instruction. In this instructional framework, you will examine a legally recognized process for disengaging from the federal income tax system without violating applicable statutes. You will not receive, nor should you seek, guidance on unlawful activities, including but not limited to, concealing taxable income, inflating deductions, falsifying records, engaging in tax protester schemes, or misrepresenting material facts to federal, state, or local authorities. Such actions are criminal offenses under 26 U.S.C. sections 7201 to 7207 and may result in civil and criminal penalties. Rather, the scope of this discussion is confined to lawful, statutory remedies embedded within federal law. This presentation will guide you through rights recognized in the Internal Revenue Code, IRC, the Code of Federal Regulations, CFR, and controlling judicial precedent. The approach herein rests on the principle that understanding your status as a taxpayer under federal law, and the voluntary nature of that designation, can have profound implications for your financial obligations. Footnote. This section establishes that the discussion is limited strictly to lawful remedies and excludes any instruction on tax evasion or fraudulent conduct. 2. Structural and legal status of the Internal Revenue Service. You may be unaware that the Internal Revenue Service, IRS, is not a constitutionally created agency of the United States government. In Schultz v. Internal Revenue Service, 413 F.3d 297, 2d Sir. 2005, the United States Court of Appeals held that an IRS summons does not carry the force of law absent enforcement by a federal court. The court explicitly stated, absent an effort to seek enforcement through a federal court, IRS summonses apply no force to taxpayers and no consequence whatever can befall a taxpayer who refuses. Until that summons is backed by a federal court order. This means the IRS cannot unilaterally impose arrest, detention, or contempt sanctions solely on the basis of a summons. Such enforcement requires judicial intervention. This principle significantly limits the agency's administrative reach over individuals prior to court authorization and underscores the role of the judiciary in protecting procedural due process. Footnote. This section clarifies that IRS summonses have no compulsory effect without a federal court order, as confirmed in federal appellate precedent. 3. Voluntary nature of federal taxpayer status. Statistical data indicate that approximately 80 million Americans, about 22% of the population, do not file federal income tax returns each year. While popular narratives may suggest that such individuals are engaged in unlawful conduct, the existence of a large non-filer population suggests a more complex legal reality. According to the IRS's own published statements, the tax system is based on voluntary compliance and taxpayers complete and return forms with payment of any tax owed. 26 CFR Section 601.602a. Under federal law, the designation of taxpayer is itself voluntary in nature. This status is typically elected upon the first filing of a Form 1040, which operates as a contractual agreement to file and pay income taxes annually unless and until that agreement is lawfully terminated. While the IRS asserts that filing is mandatory for taxpayers, it does not widely publicize that taxpayer status itself is elective and can be altered under certain lawful circumstances. Footnote. This section establishes that while taxpayers must comply with tax laws, the status of taxpayer is acquired voluntarily and can be lawfully terminated. 4. Common misconceptions and enforcement data. It is a common misconception that the IRS aggressively prosecutes all individuals who fail to file tax returns. In reality, the agency's own criminal investigation statistics reveal a much narrower scope of enforcement. In a recent reporting period, out of an estimated 80 million non-filers, the IRS initiated only 1,049 criminal investigations, recommended 665 prosecutions, and obtained 655 sentences nationwide. This translates to approximately 13 convictions per state annually. The IRS acknowledges that voluntary compliance is the backbone of the U.S. tax system and that it relies primarily on individuals to self-report income and calculate their own tax liabilities. Its enforcement priorities focus on individuals who deliberately underreport or conceal income and those with a clear statutory obligation to file. This selective enforcement strategy underscores the reality that the tax system functions primarily through consent and self-assessment rather than blanket compulsion. Footnote: this section demonstrates that IRS enforcement actions are statistically rare and largely target deliberate noncompliance rather than all non-filers. 5. Historical context, Federal Reserve and the income tax. Before 1913, there was no permanent federal income tax in the United States, and the national economy operated without it. This changed with the enactment of the Federal Reserve Act of 1913, Pub. L. No. 63-43, 38 Stat. 251, which created a privately owned central banking system. Despite its name, the Federal Reserve is no more federal than private corporations such as Federal Express. It is owned by private banking interests. The concurrent ratification of the 16th Amendment in 1913 authorized Congress to levy an income tax, and the Internal Revenue Service became, in effect, the collection arm of the Federal Reserve. Federal Reserve Notes, FRNs, are issued as obligations of the United States and loaned to the federal government with interest, creating a perpetual national debt. Income tax revenues are used, in significant part, to service this debt, linking the tax system directly to the Federal Reserve's operations. Footnote: this section traces the origin of the federal income tax to the creation of the Federal Reserve and its role in servicing national debt. 6. 12 U.S.C. Section 411 and lawful money redemption. Under 12 U.S.C. Section 411, Federal Reserve notes shall be redeemed in lawful money on demand at the Treasury Department of the United States, or at any Federal Reserve Bank. This statutory provision grants you the right to exchange taxable FRNs for United States notes, a form of currency issued directly by the U.S. Treasury and not subject to Federal Reserve control. United States notes, distinguishable by their red seals, are not liabilities of the Federal Reserve and are therefore not subject to the same tax implications as FRNs. Although their general issuance ceased in 1971 following policy changes under the executive branch, the statutory authority for redemption under Section 411 remains in force. This legal mechanism offers a path to receive income in non-taxable lawful money if properly invoked. Footnote: this section explains that 12 U.S.C. Section 411 provides a continuing statutory right to redeem Federal Reserve notes for non-taxable United States notes. 7. Practical process for redemption. To utilize lawful money redemption, you must explicitly assert your demand for payment in United States notes when depositing or receiving funds. Without such specification, deposits are presumed to be in FRNs, creating a taxable event. The redemption process may be executed by including the phrase redeemed in lawful money pursuant to 12 U.S.C. Section 411 on endorsements, deposit slips, or payment instructions. This procedural clarity ensures that the transaction is legally recognized as an exchange of taxable currency for non-taxable lawful money. Because the right to redemption is statutory, neither the IRS nor the Federal Reserve has discretion to deny a properly executed redemption request. Documentation is critical. Contemporaneous records of your demand and receipt of lawful money protect against later disputes regarding taxability. Footnote: this section instructs you to explicitly declare lawful money redemption in writing to prevent deposits from being presumed taxable. 8. Impact on tax liability. When you successfully redeem FRNs for lawful money, the resulting United States notes are not subject to federal income taxation because they are not Federal Reserve obligations. This interpretation is grounded in the statutory framework of 12 U.S.C. Section 411 and related monetary laws. Proper use of this process can lawfully eliminate your taxable income for the redeemed amounts, whether derived from wages, self-employment, investments, or capital gains. The IRS has not, to date, issued authoritative rulings invalidating this statutory redemption right. When documented correctly, the process has been used to claim full refunds of federal and state withholding, as well as to establish tax-exempt status for subsequent income. The essential condition is that the redemption must be deliberate, documented, and consistent across all income streams. Footnote. This section outlines how lawful money redemption can eliminate taxable income if executed consistently and documented properly. 9. Benefits of the 12 U.S.C. Section 411 process. By invoking lawful money redemption, you may receive your full paycheck without federal or state withholding. Have your accounts flagged as non-taxable at the U.S. Treasury. Avoid capital gains taxation on investments. Sell real estate without incurring federal income tax, and retain eligibility for Social Security, Medicare, and retirement benefits. Additionally, you contribute to lowering the national debt by reducing the circulation of FRNs, thereby diminishing the Federal Reserve's interest-bearing claims against the United States. This process offers a legally sound means to manage personal taxation without sacrificing access to credit, financing, or government benefits. Footnote. This section lists the primary personal and systemic benefits of using the lawful money redemption process. 10. Eligibility criteria. To lawfully utilize the 12 U.S.C. Section 411 process, you must maintain a residential address within one of the 50 states. Not reside in federal territories such as Puerto Rico, Guam, or the District of Columbia. Earn income in U.S. dollars, and not be employed by the federal government or a federal agency. Meeting these criteria ensures you are within the statutory jurisdiction to demand lawful money redemption. If eligible, you may become a legal non-taxpayer while remaining fully compliant with all applicable federal laws. This is not tax evasion, it is the exercise of a statutory right embedded within the U.S. Code. Footnote. This section defines the jurisdictional and employment-related requirements for lawful participation in the 12 U.S.C. Section 411 process. So now you know the lawful money process and 12 U.S.C. Section 411, a right that's been hiding in plain sight for over a century. The choice is yours: keep playing by the IRS's default rules, or use the law as it's written to protect every dollar you earn.